Hello and welcome back to another episode of Fund Friday with another great guest. Excuse me. He is the founder and principal of Streamlined Capital, Brian Briscoe. How are you today, sir?
Doing great, doing great. How you doing, Craig?
I'm doing awesome, thank you. Well, very excited to have you on the show. You were nice enough to have me on your podcast. So, of course, we're going to play a home and away here and have a fun conversation. But let's get right into it. You're
Yeah.
obviously, as I said, the founder and principal of the firm that you're at right now, which you founded not too long ago, if I'm not mistaken. But tell me, what did you do before getting into real estate and capital raising?
Before I got into real estate, wow. So I spent 20 years in the military was the answer. I was one of those guys that on September 12th ended up at a recruiter station, September 12th, 2001, and very shortly after was active duty in the Marine Corps. Enjoyed it just enough that I didn't leave. It was one of those things where, there were always times where like, man, I got to do something else. I got to do something else. In my mind, I always wanted to do something real estate when my military career wound down. And so the last couple of years, I would say from 2017 on, when I had about 16, 17 years of service, I really started ramping up what I was doing with real estate. Got into a coaching program, started, doing a lot of networking. And that's when I started buying real estate, started raising money, and you know, ever since then, it's been, multifamily real estate, and yeah, it's been great, great ride so far.
That's awesome. So you found that, did you kind of always know that was the natural progression point? Did you read like Rich Dad Poor Dad, or what kind of, or you just kind of were enticed maybe by the prospect of real estate and also kind of frankly the money associated with it too? And it's very okay if you say that, because I know that's frankly for me was of course a big draw, because I always knew there was financial compensation and very well compensation if you did well, if you're in the space.
Yeah, unfortunately, I'm not quite at a spot yet where I can just work for free for whatever I'm doing, I could probably go a long time without working, but eventually I'm going to have to make money. So that's definitely part of it. Rich Dad Poor Dad was a big part of it. I think it was 2004. I can tell you for certainty it was 2004 because I remember where I was when I read the book. But yeah, I read Rich Dad Poor Dad, and I started talking to other people. I know a lot of people in the military, they pick up and move every 1, 2, 3 years, and so you end up with a lot of accidental landlords and you end up with a lot of intentional landlords. And I started talking with a lot of people that, had the philosophy of I move, I buy a house, I move, I rent it out, and I buy another house, and so I started hearing that go on, and I was talking with people that, at the time this seemed like a crazy high number. Yeah, I've got 8 rental properties. I'm like, oh my gosh, wow. And so that's kind of the method that I tried. It's just okay, so Rich Dad tells you to add assets, and so your personal residence is not an asset according to Rich Dad, but I could use it to turn it into an asset. I could use an owner occupied loan. I could use a VA loan. I could use an FHA loan. I could get, really good financing on an owner occupied property. And then, the military gives you orders, and that's a get out of jail free card for your next loan every time. Well, why did you move? Why do you have a loan 6 months old and you're looking to get another loan? Hey, military,
Hey.
boom, here you go. And every lender respects that. So that was my strategy. I wish I would have gotten more, but in about a 10-year stretch, I ended up with 3 properties. Turns out I moved every 3 years, and so it didn't happen as fast as I wanted. But that's what got me started, and I started seeing the equity build up. I first house I bought, this is crazy. This is pre-crash. I put $3,000 in. Okay, $3,000, and I bought a $200,000 home. You know, 10 years later, I sold it for a $120,000 profit. The numbers are just off the chart. And
That's a pretty nice equity multiple.
oh yeah, I mean it's like, yeah, 35x multiple.
It's like
The
basically if you bought Bitcoin at like a couple $100 is
Yeah, exactly.
effectively a similar return.
That's
I mean,
exactly.
don't quote me on that, audience, but it's pretty
Yeah.
good.
Yeah,
Yeah.
I'm pulling my calculator right here, fact check.
Right, 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 right.
Yeah, so but yeah, and the second house I bought, the numbers were similar. And the third one, I got to the point where I had to put a little bit more down because I was overextended, and I think I only tripled my money on that house in 3 years. So I started seeing the power of real estate, and I wanted to scale. It's just like um, I started looking at how to scale, and eventually the answer came to me in the form of, don't look to buy more single family properties, look to buy larger properties with multiple units, multifamily. And that ended up being, one of those like big mental movements, one of those light bulb moments, or these big mental shifts that I've had in my life that was just like really changed my way of thinking. And end of the day, it's what's got me where I'm at right now.
That's awesome. So you have that moment, you
Mhm.
figure out, okay, I want to scale up, I want to get large, go larger.
Mhm.
So, what year did you kind of discover the multifamily beauty, and did you start kind of investing and finding these opportunities?
So I discovered it in 2016, and once again, I was on a boat again. That's where I read Rich Dad Poor Dad the first time when I was deployed on a ship, and I discovered multifamily reading a book while I was on a different ship, in a different ocean many years later. But yeah, so Rich Dad Poor Dad, not excuse me, the apartment investing 2016 is when I first really thought that I could own an apartment building. I mean, the idea had crossed my mind before, but I'd always dismissed it. I always been like, that's for the rich people. That's for people who are like at a different level. But yeah, I read a book that all of a sudden made apartment investing accessible to me, and it put it into terms where I'm like, yeah, I can actually do that. So that was 2016, and I read a lot of books, listened to a lot of podcasts. I spent 2 whole years dreaming about it and thinking about it and scheming and planning and orchestrating and just like, yeah, I'm going to do this. I'm going to do this. I'm going to do this. And finally one day I just, met myself in a real spot. And I'm like, I've been telling myself I'm going to do this for 2 years. I need to freaking do something. And that's when I decided to get into a coaching program. It's like, okay, me by myself, I'm going to keep on doing what I'm doing, and I'm going to pretend that I'm going to get in eventually. And so at the time, it was one of the larger checks I've ever written. I think down payment on one of the houses was actually a little bit larger, but threw $25,000 towards a mentorship program and then jumped all in. So that was November of 2018 when I joined the mentorship program. And then a year later, had closed on 3 apartment complexes.
That's amazing. And so for the listeners to know, Brian doesn't raise money for deals like us. He's actually the sponsor and buys deals. And we were actually talking about this before we got on the show, but I really want to hit on this. There's multiple ways to make money in real
Mhm.
estate. There's not just institutional investors, not just one market. We're not competitors in the sense that, yeah, we are, of course, buying deals. But I mean, we raise money from similar people. We've got a similar network, but totally different product type and different strokes for different folks. So you let me know that you're really making the point of emphasis this year a little bit different on your acquisition hunt. So let's just get right into it. What do you buy? Where do you buy? And what are you looking for right now as the market changes?
So where I think is the first and easiest answer, and then this came about a long way. I've got properties in South Carolina. Actually, we sold our last one in South Carolina. I no longer have properties in South Carolina. At one point, I had 9. Georgia, Ohio, Texas, 3 in Houston, where you guys are very active. Um, Oklahoma, Colorado, so I've got properties all across the nation where I'm, a general partner in. Um, but I had this epiphany one day. I'm sitting down at a dinner table where I looked around the table and I clearly did not belong. I think at the time I had, 800 units in my portfolio, and I was sitting down with guys that had like 8,000, and it was it was a little bit intimidating, but I do what I do in situations like that is I close my mouth and I open my ears. And I was just listening to these guys talk about their portfolios and whatnot. And it was the light bulb moment I had there was every one of those guys, they didn't come out and say it, but every single one of those guys got to the 5,000, 8,000 level portfolio by focusing, you know, by focusing, and I started thinking, oh my gosh, I'm scattered all over the map. I've got a partner that I work with in, this area. I got partners I work with in this area. I got people I'm partnering with in that area. I'm like, crap, I need to focus. And so the new area, Salt Lake City, it's my hometown. It's where I'm sitting right now. I don't live in the Salt Lake metro. I'm about a 2-hour drive to the north, but where is Salt Lake City? What am I buying? I'm still 100% into multifamily. Um, I like the idea. I've had this philosophy, but I think reading something from Warren Buffett helped me to verbalize it a little better. In the last annual statement to Berkshire shareholders, Warren Buffett paid tribute to Charlie Munger, who just passed away. And he said, once upon a time, Charlie gave him the advice that he should stop trying to buy, fair companies at fantastic prices, but he needed to flip it around and try to buy fantastic companies at fair prices, and that just the way they said that resonated with me. That's been my philosophy all along. I just couldn't verbalize it. So what am I trying to do? I'm trying to buy good properties at fair prices, and over time just accumulate a portfolio of good properties that I purchase at fair prices. And over the years, those prices are going to go up, you know. And I'm when I say years, I'm literally talking years. I'm not talking 12 to 24 months. I'm talking, over the years, those properties are going to go up in value. And over the years, I'm still going to own good properties. So that's, multifamily, I'm buying good properties in a great market. And that's pretty much it.
Yeah. So what's your sales pitch to Salt Lake City? Because naturally you're well researched.
Yep.
You've lived in a lot of places throughout the country.
Mhm.
You have the opportunity to invest and partner really wherever you want and buy deals wherever you want. So what is the play other than maybe familiarity? Is it, the migration trends coming there? What is the it factor and what makes you so confident in that market long term?
So what makes me, I mean, I think people can make money in any market. It's a matter of knowledge of the market and focus, and so I am kind of a new player in the Salt Lake market. Okay, we've bought one property. Um, we were looking to add four more to the portfolio in 2024. Um, but when I go back to that conversation, what I realized is these guys focusing on metros, they were able to access deals that nobody else had access to. And that's where I assume Lone Star is in like the Houston, Dallas areas, where you've got brokers that are coming to you first, showing you deals that nobody else gets access to. All right. So part of the allure to Salt Lake City has nothing to do with the city. It has to do with the focus that I'm putting into Salt Lake City. All right. Another part of it is I've spent 25 years of my life in Salt Lake City. I know the area. My parents still live here. I had dinner with my mother last night. It was her birthday. And,
Happy birthday.
yeah, I know. Happy birthday, Mom. Um, I've got a 21-year-old daughter and a 24-year-old daughter that live in Salt Lake City, so I come here frequently. I've got a lot of incentive to do well in this area. And then when you look at just the economic stats, fun fact, the fastest growing state between the 2010 and 2020 census is what was Utah, 100%. And when you look at the fastest growing, I mean, Salt Lake City is where 90% of the population is, the greater Salt Lake metro. U.S. News and World Report 2023 said Utah is the best state in the nation, best economy in the nation. And once again, 90% of the population and the economic activities of the greater Salt Lake area. Just recently, the Milken Institute ranked their top 200 big cities. All right. Salt Lake City was number 4. Provo-Orem Metro just to the south, which is usually wrapped up in the greater Salt Lake Metro, was number 5. In Ogden-Clearfield, I'm actually from the Ogden-Clearfield area, to be technical. They were like 25. So the 3 Utah cities that qualify for the top cities are all top 20, 25 cities. So there's a lot of stuff going on in this city, a lot of people moving here. Organic birth rate is also the highest in the nation. There's a lot of people having a lot of kids here as well. I'm one of 7, I've got 5 kids, and so, um, anyway, there's just kind of a buzz and an excitement about Salt Lake City. The economy's growing. There's a very active tech scene, a very active venture capital scene as well, where a lot of people who have made it big are now turning around and funding the new generation of companies, and the state's all in on entrepreneurship and business. You've got business owners. The owners of the Jazz are trying to bring a National Hockey League team here. The former owners of the Utah Jazz are trying to bring Major League Baseball here. So there's just so many big, exciting things happening here right now that, I mean, I wish I would have gotten more Salt Lake City properties 5, 10, 15 years ago. But I'm more excited right now about Salt Lake than I was 5 or 10 years ago.
Without a doubt. Well, that's a great breakdown there. So, as pertaining to what you're looking for in the acquisition side,
Mhm.
what are the things, I guess, the metrics, the makeups of properties that you're looking to buy right now? What are you looking at there?
Yeah. So one thing I would say, and I think most people in my position, what we're looking for is, I think, primarily informed by how much money we can raise. If you can only raise $1 million, you shouldn't be looking for a $20 million property. But we feel comfortable raising somewhere between $5 and $10 million per acquisition, and this is with people that come and join us on the raise as well. Um, and so our buy box right now is, somewhere 15, $20 million is kind of what we're looking for. And in Salt Lake, we're looking at 2.25 to 300 a door, depending on what you're looking at. I mean, you can get C class for, 100 high ones, but we're looking for the nicer areas and a little bit nicer stuff. But so, I mean, what that buys you, 15 million in Salt Lake is only going to buy you like 60 units. But so that's what we're looking for right now. One thing I love clustering properties together. It's
Likewise.
oh man, it's so much easier. And I know you guys have done that several times where you have, two large properties right next door sharing a fence, but um, so we're looking for properties. We've got, one purchase, two under contract, and I mean, you can drive from one to the next in 10 minutes, get to all three in 10 minutes. Um, and so I like the idea of clustering properties. It makes the management a lot more efficient. Um, and so what are we looking for? Good properties in good areas that, we can hold long term. And as we keep on adding properties to our portfolio, the management's going to become more and more efficient because we're just adding units and units and units. And eventually we'll take a page out of Lone Star's book, become vertically integrated, and do exactly what you guys are doing. Just
Yeah.
in Lake.
Yeah, absolutely. And it's the beautiful thing about this business, and I think you hit on some things that I want to unpack a bit more. But specifically pertaining to uh, being in a mastermind
Yeah.
and having the right people around, doing what we're doing, all this, there's a blueprint for this. It's not rocket science. It really isn't in many respects. It's just finding the right people to network with. So I just want to hit on this point. If you're looking to get in this business, looking to meet more people in whatever niche you're in, it doesn't have to be in real estate. Join mastermind, join
Mhm.
groups, go to retreats, go to conferences. This is where you meet people that you're legitimately going to be transacting with. It is the best investment you could put back into yourself and in your business because you just don't know where it's going to take you. So I just want to, hit everyone with a little PSA there, and I'm sure we'll be seeing each other at Best Ever. I think by the time this
Yep.
airs, that'll be past Best Ever, but that's neither here nor there.
Yep.
But at any rate, you mentioned something pre getting on the conversation today before recording, which was sticking to the fundamentals.
Oh
So,
yeah.
can you explain, really what that means for you and how you can get comfortable with deals? Because although the market's obviously a little bit easier to navigate right now with cap rates kind of rising, we're definitely getting some discounts, but it's
Mhm.
still easy to lose money. So, in your words, how would you kind of define that? And, what is the strategy as it ebbs and flows throughout the next couple of years?
The real estate fundamentally is a long-term investment. Okay. I think that's the fundamental of real estate. I mean, yeah, you can flip a house and make a quick penny. But one nice thing that the real estate market does tend to move fairly slowly. I think fundamentally, it's time in the market and not timing the market. And so I use a quote a lot on LinkedIn. It's don't wait to buy real estate and wait. Now, that quote is attributed to Will Rogers, and it's over 100 years old. And I think the fact that it still applies today just as well as it did 100 years ago means that it's accurate and it's right. So what do I mean about the fundamentals? It's what I was saying earlier is you buy good properties, you buy fantastic properties at fair prices. All right. And then going back to, a line from Warren Buffett, his favorite hold time is forever. So when he buys businesses, now a lot of people, will look at what he does with securities when he buys stocks. He's not talking about stocks. He's talking about buying businesses. His best hold time for businesses is forever. And I think that applies to real estate just as well. You buy a good property, you maintain it, you keep it nice, you keep it well maintained. And unless the dynamics around that property change, I mean, you hold long term. I think that's really the fundamentals. And in fact, I was talking with somebody earlier today, and a friend of mine, I don't know if have you had Bruce Fraser on this show? If you haven't, you
Not
should.
yet. No.
All right. Bruce Fraser, great guy, out of Dallas. But I remember he got on a stage and he said, if I were to go back to August of 2007, okay. And for those of you who don't know, that's when the single family real estate market peaked before the crash. Incidentally, that was also when I bought my first single family home. Actually, I think the market peaked in October. I bought my first home in August. But he said, if I were to go back to fall of 2007, I would buy everything I could get my hands on. Everything. And everybody thought he was crazy, and he explained exactly what I just said. If you look at the prices in 2007 versus the prices in 2024,
They were a bargain. Yeah.
they're bargain. Okay. That's the fundamentals. All right. The fundamentals aren't go out, get a bridge loan, get up to 85, 90% leverage and, try to flip it and sell it for, 15% more so you can double your money because of the leverage. That's not the fundamental. That was just kind of a part of the
Well,
that, yeah.
y- yeah, no, I fully agree. And to that point as well, I think us, this is why I certainly like your perspective, but we're in alignment there, philosophically speaking, in reference to hold periods and whatnot. And just for any investors out there who wants to invest in a bridge deal or floating rate deal, really more for the bridge situation here. Floaters are unique in their own right now, but just for a bridge deal, just realize the risk associated with an investment is directly correlated to the debt that's placed on the deal. So when you have a 2-year tarmac, you're really, really trying to thread the needle perfectly in order to make it make sense. And of course, a lot of people recently have done it, and maybe there's unique situations where that structure needs to be put in place. There's a reason why it is in fact there, that debt vehicle. But just realize that long term, over the course of investing, you're going to get burnt at some point, and you could lose a lot of equity there. So just buyer beware on that one, investor beware. And that also begs the next question, which is, when you're pitching these deals for your investors, you're probably looking maybe for a different type of investor. Is your goal to, I guess, promote, crystallize this? Is it to hold it indefinitely? Are you trying to set up a situation where you do a 10-year pro forma? Because to find investors on a 10-year pro forma or whatnot, it gets very competitive, but we all know that IRR over the course of time gets compressed. So unfortunately, you're doing the right thing on a long-term time period. It's just there's a shinier object syndrome. So I'd love to hear you unpack all of that.
Wow, you hit a lot of nails on a lot of heads, and I think alignment. I mean, perfectly aligned on a lot of things. Yeah, I mean, when you do a 3-year hold versus a 10-year hold on the same property, your IRR is going to be a lot higher on the 3-year hold because you're giving everybody their money back sooner, right? And so yeah, when we're doing 10-year holds, we're not hitting mid-teens on our IRRs, like a lot of people. A lot of people are looking at mid to high teens on a 3 to 5 year hold. We're in the 13% range on our IRR. And so it is very much a different type of investor, you know. And in Utah is a high-priced market. It's a low cap rate market. And so when you look at our loans are always DSCR constrained, and so we're typically coming in at 65% leverage. So we've got two things against us as far as maximizing returns. But as you said, you know, the risk comes from that loan. And if we're coming in at 65% leverage, there's a lot less risk on the table. If we're holding for 10 years, there's a lot less risk on the table. So, we're coming in usually 13 to 14% on our IRRs. I'm happy at I'm happy making an offering out at 13, but it is a different type of investor. I think the more sophisticated investors, the more seasoned investor. That's a better word. I think sophisticated, you get confused with the SEC definition, but the more seasoned investors see what we're doing and they're like, yeah, I like that. I think a lot of the newer investors are chasing returns, and the ones that are chasing returns are the ones that jump into those bridge situations without really thinking about it.
Well,
And sometimes they win, sometimes they lose.
and to that point, when you are a newer investor looking for that,
Mhm.
you're almost asking to get lied to.
Mhm.
You're
Yep.
almost asking to shop around from sponsor to sponsor to say who's going to show you the shiniest object with the best marketing, with the most conviction on doing something that they don't know they can perform or not, or you're really threading the needle. There is no free lunch, okay? There is no silver bullet, silver bullet. The person who wins the deal and buys the deal is the one who paid the most, okay?
Exactly.
So there's no, magic solution there to make that make sense. There are situations where there are heavy lifts or there's potentially the upside there, but that's also very risky because there might not be any cash flow. So as I said, there's no free lunch, but also if you're an investor looking for the highest returns, you may be subjecting yourself to having maybe not the best and more robust business model on an opportunity.
Mhm. Yeah, it's true. And I think, risk, it's always risk versus reward, and sometimes the risk versus reward is obvious. A lot of times you have to dig a little deeper. But I mean, 2 or 3 years ago, I was very fortunate. We didn't take any of the floating rate loans. We had a credit union that we had done business with several times before that had, a bridge-esque loan. I mean, they were giving us 75 to 80% loan to value. So it was a similar proceeds. They were funding a lot of our renovations. But the great part is they did it with a fixed rate, and the fixed rate started with the number three, and so I mean, we got 4 or 5 different loans from that same credit union, and they were all at 3.7%. It's just they set their loan rate once a quarter or once a year. And but yeah, I mean, when you start looking at it, I think one of the very fortunate things is, we recognized early on, it's not because we had a crystal ball, it's just because, it's like, okay, we have two similar loans, one of them has a fixed rate, one of them has a variable rate. Which one should we take? And like I said, we were extremely fortunate. I don't know, if we didn't have that credit union and we were faced between a bigger delta in the interest rate and proceeds, I don't know if we would have been, mature enough at the time in the industry. I mean, I was still above 40, but I didn't know if we would have had the experience or the wisdom to be able to choose the right one.
Yeah, without a doubt. So do you think moving forward, kind of living through this experience that you'll kind of change your perspective on acquisitions and how you structure the debt and equity?
Yes, I do. I do like, I don't want to be up against a wall. And actually, I just hire somebody today. I went over my debt philosophy with him is I want flexibility with the debt. Okay. So, Freddie Mac, let's just look at a 5-year Freddie. Most, if you just go to a broker and say, give me a quote on a 5-year Freddie, what is it going to look like? It's going to have a 5 4 3 2 1 prepay or step down prepay. All right. And that's not bad. It's a lot better. It's a lot more flexibility than like a yield maintenance would have on the back end. But I think the Fed's going to start cutting rates. I don't know when, I mean, eventually the Fed's going to cut rates. It doesn't matter when. They're going to go up, they're going to go down over time. Eventually they're going to come down. Whether it's 3 months or 3 years. But I want to be ready in case it happens sooner rather than later, right? So, I mean, I just paid $15,000 for a loan application, put a little bit more we're getting a little higher rate and a little lower proceeds. So I can get the, the 2100 32100 prepayment penalty. All right. And what that gives us is an option to refinance out a little bit earlier without paying as high of a price, right? So if rates do come down from where we're at right now, we have a little bit more flexibility. We don't have as big of a prepayment penalty, and we can exit a lot easier, get into better debt, lower fixed rate debt. But so I am definitely looking for products that give me a little bit more flexibility on the back end, though you do pay for back end flexibility a little more on the front end, either in higher fees or a slightly higher interest rate. So yeah, bottom line is I don't want to be backed into a corner because of the debt.
Sounds good. And that fully makes sense without a doubt. What are the other metrics that you're looking for right now? And how are you kind of handling and handicapping entrance cap, exit cap, insurance? Is there any kind of, weird kind of, I guess, profile that kind of blows up underwriting specifically in Utah or in Salt Lake as well? Like, because Houston, of course, we're dealing with insurance, or if you're in Florida there, but be curious to know, if there's any weird, out of the normal, items you have to solve for, or think about in Salt Lake City, and then also entrance and exit cap.
Yeah, so I mean, as far as natural disasters go, Salt Lake City doesn't have a lot, so no ocean, so no hurricanes, it's not flat enough for tornadoes to form, there are occasional earthquakes, but there hasn't been like a big natural disaster here I mean, I'm 40 something years old and I haven't seen one, right? So
And you don't hear about it from my perspective either, as someone who's been to Salt Lake once for a conference and didn't leave the Hyatt. So
yeah, yeah. I mean, every 15 or 20 years we have a really, really wet winter, a really snowy winter, and a warm spring, and so some of the rivers will flood, and that's about it, every 15 years or so that's what we get, but it's in the same places every time. Um, so yeah, as far as insurance rates, we're still getting pretty decent insurance rates. It's not as nice as it was 5 years ago. But we're looking at 5 to 600 a door instead of like I know some Houston properties I've seen were like 12 to 14 a door. Um, I mean, in the wintertime, we do have snow removal, which some winters is a lot higher than others. So that is one expense that if you're used to, living in Texas, you see it on the T12, you're like, snow removal, what's that? Um, I mean, property taxes are fairly low, insurance is fairly low here. So, I mean, our expense ratios on a lot of these properties is, 30 something percent on a lot of them, so, um, yeah, the hard part right now is like what we're seeing nationwide is 2023, 2024, and into the beginning of 25, there's a lot of new deliveries. There's record deliveries in Salt Lake City. And people without looking at the dynamics are saying, oh my gosh, they overbuilt in Salt Lake City. No, they didn't. There's still a big supply and demand crunch here. They put a dent into the supply and demand crunch. But with all of this new inventory coming online, first year rent growth, we might not see a whole lot of first year rent growth, especially downtown. That's where most of the deliveries are. So when you're starting to look at the dynamics year over year, average rent growth for I think 2000 to 2020 was 7% in Salt Lake City. We typically underwrite, I think, 3.5% to 4% rent growth, which in some metros would be a little bit aggressive. I think in Salt Lake City, that's a fair number. But the question is, are we going to see that year number one? Probably not. But like most of the rest of the nation, we're looking to have, a decrease in inbound supply in 25 and 26. And it's too early to see what's happening past that. So, I mean, that's kind of like the market dynamics that we're seeing that, might change your underwriting. Um, Entry exit caps. I mean, right now I'm bullish. I think Salt Lake is I explained all the factors why I think Salt Lake's going to continue to grow. There is something else that's real in Salt Lake, and that's called you've got mountains on both sides. I look out this direction, okay, which is to the west. I see mountains. Those are the Ochre Mountains. I look to the east. I see the Wasatch Mountains. If I were a little bit higher and I were looking to the northwest, I see a Great Salt Lake. And they've pretty much built the Salt Lake Valley out. And so when you start looking at, where can the new people go, it's they're in the point where they're doing a lot more infill than developing the outlying areas. But the outlying areas are up against the mountains, so there's not much more to be developed. So I think there's going to continue to be that influx of population. There's going to continue to be a shortage of housing. I think housing is going to get more expensive because a lot of times they're knocking down buildings to put bigger buildings up. So, I think all of that bodes well long term for investing in Salt Lake. So, I mean, entry caps, the last building we purchased was at a 4.8 cap. Two we got under contract right now are low fives. I think we're at a 5.1 on one of them and a 5.25 on the other. So, I mean, compared to the rest of the nation, I think we're still relatively low. A couple of years ago, I mean, there were apartments that were trading in, I think 3.5 to 4 was the average range for where things were trading. So that's where we're at right now. I mean, my exit caps, what we like to do is give investors a range of exit caps and say, hey, we're buying at a 5 right now. Here's what it looks like if we sell at a 5.5. Here's what it looks like if we sell at a 6.
I
You
love
know,
that.
yep. So
Yeah.
here's what it looks like if we sell at a 4.5, and the numbers just pop when you sell at a 4.5. But I mean, over 10 years, even at a 6 cap, you still make money.
Yeah, well, and that's just something that Rob and I have had a lot of conversations on too, is, really gearing up for the kind of paradigm switch as you've kind of discussed here, which is not threading the needle, but having more long-term holds and, raising equity from people who see the vision there. And, we always say this, we don't want to have the biggest business, but we want to have the smoothest business. And that
Mhm.
means buying, better quality real estate, buying
Yeah.
well at a good basis with a solid business plan. That's what makes sense to us. And then, we rather have investors that are gung ho and excited about a 12 to a 14 IRR or 10 to 14, knowing how good of a deal this is. And even over a 10 period of time, you're still doubling your money. So it's hard to beat that long term. So we really are striving to have folks who are interested in that and people not really chasing the hottest and best and quickest deal. And I'm even starting to say this in the new conversations I'm having with our investors and for capital raisers, people of that nature. I'm like, listen, if you want to chase the highest IRR, it was nice talking with you because that's just not what
Yeah.
we're going to show. And if you're looking for the most aggressive deal to make the most amount of money for as a capital raiser, it was nice meeting you. But I think that's as far as our conversation goes. But if you want to really buy into our partnership, buy into what we're building here, and realize that we're actually underwriting not to what the market's doing, but what we believe in, and you
Yeah.
want to be in the ship that we're in, then that's fine.
I think what I'd add to that investor or that capital raiser is come back to me in 2 years because you're going to want to come back to me in 2 years. They might go out there and try to chase those IRRs, and they might win on a couple, but as you said earlier, with the higher risk, you're more likely to lose, and eventually you're going to lose if you keep on doing that. So I mean, when you're looking at the 12% IRRs, there's something called sensitivity. You look at inputs versus outputs. And a highly sensitive deal means a small input gives you a big change in your output. And some of these highly leveraged deals, what people don't realize are very sensitive to the inputs. Okay. So if you move from 75 to 80% LTV, you know, you get a very, very big change in the outputs, so or if your rents don't go up as much and you're highly levered, you get a very wide change in the outputs. When you come in with these deals that are lower levered and you have a small change to the input, you get a small change to the output. So they're not nearly as sensitive to your inputs as well. And so yeah, what that means is, you know, we might not hit the home runs that some of these other ones do. I mean, I'm probably not going to give somebody a 50% IRR in 2 years. There are a couple of deals that have I know of that have hit those numbers. I'm never going to hit those. Okay.
And they didn't think they were gonna hit those either, for the record.
No, I mean they got lucky. They bought at the right spot. The market went up like crazy, and they're just like, oh my gosh, let's sell right now. Um, yeah, but on the flip side, I'm probably not going to lose any money either. So
And the way I look at it as well as exactly is give me slightly better than a market beta over time with tax advantage returns, and you're going to look up being very wealthy if you just contribute every single year and invest in every single market and every single point of the cycle, right? So that's how we look at it as well. And I have a question as we kind of unpack this. With where you're kind of at in your business, what are the kind of some of the pain points that you've gone through? And what are the pain points that, if someone's starting, kind of their own firm, their
yeah.
own, branch, should they be expecting to go through?
You know, um, Pain points at the first company where we're all people, partnership level. And, I started the next company thinking I'm going to solve that and I'm not going to have any partners. And instead, I'm going to hire employees. And, to date, in the last 12 months, I've hired 4 people. One is still with me. And well, actually, 2 of them are still with me right now. I had the fourth hire was yesterday, so very fresh on the subject. But yeah, I fired somebody 2 months ago. I had somebody else put 2 weeks notice in to go work for a larger firm. Um, and so the people issue is really the biggest challenge. It's not buying the properties, it's the people. And so, it's something that I've really been putting a lot of thought into, you know, um, put a lot of thought into firing somebody. Is it the right move to fire him? And after thinking about it, I'm like, yeah, it's the right move. I would be better off working by myself. So, I mean, when I came to that realization, it was easy to make the fire. But when somebody that had been, hard worker and producing put its 2 weeks notice in, that was, you know, probably a lot harder for me to deal with than firing somebody. It was just like crap, because part of what I went through internally is, was it something I did? Was it, what could I have done better? Could I have paid him more? Was I not paying, was I not doing this? Was I not doing that? Am I a dick? Or am I just a nice guy? I don't know. So really it's a challenge finding the right people. And my view on people, amazingly, is the same view I have on real estate investing. I want to find somebody that, you know, yeah, they're going to be an employee at first, but I eventually want, whoever I hire next to be with me 10 years from now. All right. And before that, start giving equity in the company away to them. So I want somebody that can be that partner for 10 or 15 or 20 years. And ideally for me, they're a little bit younger than me. I'm 47 years old right now. I've got at least 10, maybe 15 years left of really, really working hard. And but yeah, the people aspect. I left the first firm because of the people aspect. Had nothing to do with the properties, had nothing to do with anything else. It was a people problem. And right now, the struggle that I have is the people problem. Making sure that I have the right people in the right seat, um, and trying to find the people that are going to want to stay for a long time and people that I'm going to want to stay a long time.
Yeah, and that's such a balancing act there. And you know, it's just different strokes for different folks. And people want one thing and maybe want another thing, later on. And there's shiny object syndrome for sure out there, especially for people that are my age. I'm 29, and I have so many friends who have been at a company seemingly every 8 to 12 months, because that's kind of the tech sales world. They're kind of in and out. And then I have some friends similar in that space that have been in the same company since graduation about,
Mhm.
almost a decade ago, 8 years ago. And then so people kind of ebb and flow and move, and it's tough to have that, thought there and to want to stay. But I'll say this on my end personally, to that point, I did residential real estate in the Bay Area, then I did it in Phoenix, Arizona, and then I joined Lone Star a couple of years ago. But I
Yeah.
will say this is that if I went to Lone Star and switched it up again, which I have no intentions of doing, I want to be at this firm indefinitely. But then I have to start asking myself, and just for anyone who's kind of, closer to my age range, are you ever going to get serious and focus on something, or do you just want to be in and out, and really never get great at anything? Because that's what's going to happen if you kind of keep moving it around and whatnot. I think about my learning curve from year one to year two, and it's, monumental. I knew nothing to start, although I was in real estate, it's totally different to now where I feel like I'm, approaching expert level, which is really great. And I have so much to learn and I still will. And this is why I like having conversations with people like you, but just kind of a PSA for kind of people out there that are kind of in my age gap, or if you're even younger, if you're, somewhere between 18 to 35, I'll just call it 18 to 30, and you're working, you don't go to college, but 22 to 30, let's stick there. At some point you need to focus, you need to realize, hey, it does not make sense for me to jump around. You need to commit and stick to something. No longer is it appropriate to be the person who's, a career-long floater.
You know, your generation is getting a lot of criticism from my generation. I am the tail end of Gen X. Depending on what numbers you look at, I'm either Gen X or Gen Y, but I think I more identify with Gen X. But guess what? The greatest generation was looking at my generation, and man, those guys are bouncing around from job to job. They don't focus. When I look at where I was in my 20s, I mean, I was 25 when I got my first job, and that was Marine Corps. I was in college before that. But when I look at my friends' trajectories and what a lot of them did, very few of them, got out of college and have worked for the same company ever since. So I think it's more of an age thing than it is a generation thing, I think, but I might be wrong. I think my generation was probably just as skittish and just as much. I can't see myself doing this for the next 40 years and moving from one thing to another until they found something they could tolerate, or they got into a family or they liked, or they got into a family situation where tell you what, for me, it was having, two kids in a 3-year period. And it's just like, crap, I need this job more than this
Yeah.
job me.
Well, it's so funny. I think on my end, I don't have kids, but when I kind of got my mortgage and having legitimate, payments and a debt obligation, that'll change the way you spend and how you look at your money and, really everything else because, you don't own the house, the bank does. Now you get all the upside on the property, of course, but,
Yeah.
make no mistake, you are not in first position. So
Yeah.
it is, an interesting thought exercise there and something to think about for sure.
Yeah.
With that said, obviously we have a looming recession coming up. What is making you most nervous with what's to come? With, a lot of supply coming up, as you alluded to earlier in the conversation, with, rates being where they are, with, maturities coming up, I guess to answer or to ask once more, what is making you nervous?
Nothing. I mean, recessions don't make me nervous. I've lived through a lot of them. They're all a little bit different. Recessions bring opportunities, and some of the biggest wealth transfers in history have happened during recessions and depressions, right? So, yeah, I mean, every recession is a little bit different. Different sectors of the economy are hit differently. But realistically, recession might last, I guess definition of recession is 2 quarters. Yeah, it might last 2, 3, 4 quarters, and we'll be back on the right track again. But it's the same philosophy long term. If I'm thinking, the next 2 years, fortunately, I'm in a spot where I don't have to think, what's happening in the next month. Yeah, the recession. I mean, here's the reality. People have been predicting this recession for 2 years now,
They
right?
know they were predicting it in 2017. They
Yeah.
were saying it was going to
But
happen right when Trump got in.
true, and I remember in 2019, our first real estate project, we got a 12-year Fannie on it because the yield curve inverted in 2019. Now, there was a COVID-induced recession in 2020, but yeah, people have been predicting this recession for 7 years now. So
Yeah.
if I got nervous every time somebody said, "Oh my gosh, a recession's coming up," I'd never leave my house.
Yeah.
So
Well, and on
I'm
top of that, in the space that we're playing in too, recession or not, you can find good deals at every point of the cycle. And honestly, it creates opportunity, which is the next question on the other side of the coin. What's getting you most excited? I mean, it's really cool on your end, probably. You're looking at it, licking your chops, like, wait, I might be able to start, this ride as a sponsor, with this new venture and ride the wave up and have an impeccable track record. So I guess that's what making you most excited for the buying opportunity.
I couldn't have said it better, you know. Oh my gosh, yeah. So where do I think we are in the market? I don't know if I came up with this or whatever, but I think we're close enough to the bottom that you can reach out and touch it. You know, it's like I don't know if we're at the bottom. I don't know if we hit the bottom and we're going back up a little bit, but I think we're close enough that you can reach out and touch it. So yeah, what gets me excited is just, I'm very bullish on the future of Salt Lake City. You've got a lot of a lot of investment that's coming in, not just capital, but people who are investing in human capital. Like I mentioned before, you've got a lot of VC type companies that have set up shop in Park City and along Silicon Slopes that are looking for the next unicorns. I mean, looking for the next Adobe, which Adobe is, the founder of Adobe is a University of Utah grad. Go Utes. But anyway, they're looking for like the next big thing, and they're putting a lot of money into developing people, and they're putting a lot of money into developing, the businesses around here. So, I mean, I think Salt Lake City is at like that hockey stick pivot point on their growth. I think that the next wave of growth in Salt Lake is going to be as much economic as it is population growth. And I think we're going to see amazing things happen here. So, yeah, we're at the bottom of a real estate market. What you said earlier, you said you're like one of the odd people that, wants rates to stay where they're at. I don't care if rates go up. I don't care if rates go down. It's something I can't control. But here's the reality. To your point, if rates stay where they're at, they're going to be more distressed. There's going to be more deals, and there's going to be more sellers coming down on pricing. Okay. Which is good for me. It's good for you. Okay. It's not good for the properties that I currently have in my portfolio, but we can hold them long enough where it's going to be good. If rates go down, I mean, it's still good for us because that just means the property values are going to start going up sooner. And I mean, we can ride the wave up. So either way, long-term perspective, if rates stay where they're at, I'm going to keep on buying. It's just going to be more distressed properties and distressed debt, not necessarily distressed properties. What I'm seeing here is the properties with distressed debt are all almost fully renovated, right? And so it's somebody who had a bridge loan who over leveraged themselves because they're doing renovations. And so, a lot of the distressed debt properties I've seen here in Salt Lake are all in amazing condition, brand newly renovated, and it's almost hard to find a value add deal here right now. But yeah, that's what I'm excited for in the future is just the growth we're going to see in Salt Lake because of, the investment that's happening here. A lot of local investment, just investing back into their own community, which, I've lived in a lot of other areas. I don't think I've seen this type of investment into the own community that anywhere else I've ever lived.
Right. Final question. What is your hottest real estate take, if you have one?
Hottest real estate take. I've invested in a lot of properties, 18 to date. Average property size that I've invested in is less than 100 units, but I've invested in over 100 units. I've invested in under 100 units, but hands down, my best investments have been the smaller properties. It's I don't know why. I do know why, but a lot of times you can get better deals on smaller properties. You have a lot of less sophisticated owners. And you have brokers that are a lot less enthused by the commission size. I mean, if they sell a 40 unit property versus a 140 unit property, they're getting a lot bigger commission check on the larger one. So a lot of times you can get into the smaller properties at a better basis price, better cost per door. It's not as easy to manage them, but I like to cluster properties together anyway. So I think one of the biggest things is, 100 plus units doesn't always mean you're getting a better deal. All right. There's more to it than just unit count. And a lot of times, you know, a lot of times just because of the dynamics, you can get two smaller properties next to each other. Done it twice before where we've gotten an 80 or so unit next to a 40 or so unit. And, one of the things I'm trying to do here in Salt Lake is cluster my properties together, which will allow us to take advantage of, different size opportunities. So if we've got, two properties, within a mile and another one pops up that's a 30 unit, and it makes sense as a deal, we can still jump on it and still turn it into a really good return. Obviously, we're still looking for the 100 plus, but as I mentioned earlier, I need to be able to raise another 5 to 10 million per deal to crack that barrier here.
Not a doubt. Brian, you've been so great. Thank you for coming on the show. Where can people find you and reach out if they want to partner, bring LP capital, pick your brain, learn more about the market and how they can get involved with you?
LinkedIn is probably the best place. For all of those things, LinkedIn is the best place. If you're not connected with me on LinkedIn, hit the connect button. I do message everybody that connects with me. All right, a little bit of a lie. I do have a virtual assistant that messages everybody that connects with me. But after that, the conversation, you're going to be talking with me. So, LinkedIn by far.
Awesome. Thank you so much for coming on the show. For everyone listening, we will catch you next time. Peace.
Fun Friday.